Folks, in today's video, we are going to break down the top 7 stocks to buy heavy before November 2025. Now we're going to break down each of these and explain why each is a great deal at current prices, is screaming buy, has long-term proof of concept, and most importantly is one that you could feel great buying and accumulating over time during both bull and bear markets. I'm a big believer that folks do the best when they buy stocks that they both have confidence in, but are also good stocks that they don't have to wake up in a panic every morning when they check their phone. And these are all stocks that fit that criteria. I'm going to present the data, my opinion, and I'll let you be the judge. As always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, we got to start with market context. So markets have been going back and forth within range since all-time highs on October 9th. And when markets are stagnating in this way, you tend to see many companies that outperform the market on green days start seeing huge sell-offs as people get more risk off. And this is all part of the process. Right now, we are in a renewed breathing pattern because of renewed trade anxiety, some credit issues at small banks, some tariff drama, and so forth. And so the question then becomes, are we going to see a breakout soon, a stagnation, or a further breakdown? And what I would say when I'm looking at this is, who the hell cares? When I'm looking at a stock to buy, when I'm looking at a good setup to buy, I'm not asking myself, am I going to be right over the next 3-4 days? Am I going to be right over the next couple of weeks? Am I going to be able to predict when Trump's going to make another tweet that either causes markets to pump or dump? I'm not trying to predict any of those things. What I'm trying to look for is good assets at good prices and over the long run. I don't need to be right today or tomorrow or next week. I need to be right over the long run, right? If you look at our top plays for many, many years back, like for example, Palantir, there's a lot of periods where you had multiple quarters when it was down. Yes, eventually you get into a cycle where it all looks easy, but the long-term bigger picture, the ones that perform the best are the companies that markets didn't believe in, that markets kicked down, that markets shied on. And these are the companies that are set to outperform. Remember folks, pricing in the short term is based on the emotions of the masses, but long term is where real value shines. Markets could be fooled into thinking something is horrible for a quarter or two, and they could be fooled into thinking things are great for a quarter or two. But over the long run, you can't fool anybody, and that's what we're trying to arbitrage here. Now, that being said, I have to tell you, one of the biggest issues for any market participant is really the issue of analysis paralysis. People overanalyze everything. I've been here posting videos since 2018, and I found that many people in the comment sections and in my emails and in overall messages who actively follow the stock market want to get more into the stock market, but they actually don't because they endlessly are talking themselves out of it. You're always in a period where the market's either too expensive, the market's falling too fast, it's recovered too fast, it's a fake out, it's too expensive again, the dip is back, but the dip will last endlessly. They think whatever Trump said is going to destroy the US economy permanently, so they can't buy the dip and then rinse and repeat. All of a sudden you've recovered again, and again they're like, oh, it recovered too fast, it's too expensive now. Panic skepticism, markets keep running overall. One of the most frustrating things in the world is waiting on the sidelines, waiting for a big crash, and you have all this cash that's in USD that's getting decimated year over year, and you're just waiting with all this cash on the sidelines as markets rally higher and higher year after year after year. And then when you finally get a dip, when you're finally right after years of waiting, what happens? Well, maybe you lose your job. Maybe you actually get way more conservative because you're like, oh, the economy's trash. And so what happens? Well, you don't end up buying the dip. Your dollars have depreciated and the rich have just gotten richer because they didn't need that extra cash for their savings. They didn't need that extra cash to keep them afloat. My viewpoint, and it's backed by 100 years of market data and really common sense, is that simply buying good assets at good prices over time is the way to go. Not overanalyzing, not trying to predict the tea leaves, but rather buying good assets at good prices over the long run. Why exactly does buying and accumulating good stocks over time make sense instead of trying to time everything? Well, because over the long run, these good stocks will be pushed upward over time by money printing. They will get smarter and more profitable over time, and also massive extra bonus points if they're in an exponentially growing industry. That's what separates a good stock from a great stock, right? Now, what is the catch with this system? Well, the catch is volatility. Volatility is the price that we pay for outperformance. A lot of folks do not want volatility, so they'll stay in the US dollar, which doesn't have as much volatility. It just goes straight down. There's no question of like, oh, where's it going to go? Because people are like, oh yeah, it just goes down. Most people would say, I'd rather have something that I know is going to go down versus something that I know is going to go up in the long run, but it's going to have volatility, right? That's usually the choice that people make. I'm a big believer in having 6 months, maybe even a year worth of cash on the sidelines if necessary to give yourself peace of mind, and then not touching that, keeping that in treasury bills, keeping that in high interest savings accounts, whatever you want. But after that, keeping all this cash on the sidelines while it's just getting eroded in value, I think that's a losing proposition. So anyways, you have to accept that volatility is inevitable, and it's actually a good thing when you consider that volatility helps us outperform. The reason that we came out so hard to buy the dip during this past April tariff crash, during 2022's interest rate hike crash, during COVID lows, and during many other mini corrections over the years here is specifically because we love the volatility. We love getting a good deal. We don't care if we catch a temporarily falling knife. We don't care if people make fun of us because we like Palantir at $7 and then it went down to $5 for half a minute. What we care is what's going to happen in the bigger picture, right? So anyways, with that being said, in today's video, we're going to break down the top 7 stocks that I believe have the setup that fulfill all of these ideas. By the way, quick plug, if you want to get the full ZipTrader experience, consider joining us with that first link down below. Once you join our Discord, you're going to get immediate access to all of our ideas and alerts, our stock briefings, usually 5 to 10 daily chart and setup analyses, our daily morning briefings, our price target forecast sheets, our model portfolios, our urgent news and catalyst AI bots, which are very, very popular, by the way, and our 10+ hour video lesson library. If this is something that interests you, I'll put the link first down below. Okay, let's start. Number 7, ASTS. This is AST Space Mobile. It's a hot satellite stock that has attempted to build the first space-based cellular broadband network that connects directly to everyday smartphones. There's no special hardware, no satellite phone, just your existing device connecting to satellites that act as cell towers in space. Backed by partnerships with major global carriers like AT&T, Vodafone, and Ruka-10, and just recently Verizon, well, ASTS is positioning itself to fill one of the last major gaps in connectivity: the billions of people still living in mobile dead zones. The bull case here is that if ASTS successfully scales its Bluebird satellite constellation, it could unlock a massive global market. This is a classic early stage story with extraordinary upside if execution aligns. This is a company at the intersection of telecom, space, infrastructure, and global broadband. Now, what about the chart setup? Well, here's what we sent out to Discord members today. ASTS satellite stock is finally heading towards a deep deal zone, which means we are soon going to identify it as a buy idea. We see the deal zone as the $55 to $65 range for the long-term picture. The company has a very unique value add as a satellite play. 5 billion people own mobile phones, yet hundreds of millions still live in dead zones without reliable coverage. Governments, carriers, and enterprises are all seeking ways to close that gap. ASTS aims to monetize both consumer connectivity and enterprise data partnerships, tapping into a global telecom market worth trillions. Potential market size dwarfs the company's current valuation. Okay, number 6, Supermicrocomputer SMCI. So this is one of the most talked about stocks in the AI world right now, and for good reason, but the stock, in my opinion, is still trading at a very good deal range, way below all-time highs, while all of its competitors and peers that I'd argue are actually worse in many cases are way above all-time highs. The company builds the servers and systems that power artificial intelligence, cloud computing, and massive data centers. In plain English, when companies like Nvidia or big tech giants need racks of hardware to train AI models, well, SMCI is one of the few companies that can deliver fast, custom-built systems at scale. But what really makes SMCI stand out is how fast they move. When Nvidia and AMD drop a new chip, well, SMCI is often first to market with systems built around it. Their building block design lets them mix and match parts very, very quickly, kind of like Lego for supercomputers. This gives them a big edge in an industry where speed matters, because every company racing to build AI infrastructure wants to build hardware not today, but yesterday. So whoever's fastest to market and has that speed component is going to outperform long term. The trends around them are massive. Nearly every major company, as you know, is pouring billions of dollars into AI infrastructure. It's going to be many, many trillions long term, and SMCI sits right at the heart of that spending wave. And they're not just selling servers, they're selling entire pre-built AI factories that companies can install almost like plug and play units. Overall, you got to understand that the more data centers get built, the more SMCI's products and business strategy become valuable. They are essential parts in the current AI arms race and in the current AI ecosystem. What about the chart setup? Well, this is what we sent out to Discord members. Quote, SMCI is arguably one of the best deals in the AI arms race, and we believe this will shine through 2026. Supermicro is deeply embedded in the supply chain for artificial intelligence and high-performance computing, and the company guided to US $40 billion in revenue for fiscal 2026, implying a very steep growth path. The combination of new server architectures, higher average selling prices, and potential catch-up from delayed orders could act as a trigger for acceleration in 2026. And in effect, if you look at the chart breakdown, we do see SMCI getting back into the hundreds next year. Number 5, Applied Digital, APLD. Applied Digital is a company that designs, builds, and operates high-performance computing and AI-specific data centers. Their business is all about providing the infrastructure backbone for large-scale compute, data center hosting, GPU/HPC hosting, and cloud services. Now, we've been big fans of APLD since way lower prices, and we've made many public videos about this stock. However, the reason that APLD stands out is because it's not just offering generic data centers. It's actually focused on next-gen design. Things like liquid cooling, high power density, and proximity to cheap/renewable power sources. This gives it a big potential edge whenever companies need huge AI factories, right? A data center is basically an AI factory, and those things suck up so much power and have so many potential issues that you want to make sure that you have the most power efficient apparatus equipped with great cooling systems so you don't have any big downtime. In terms of proof of concept, you've seen them lock in lease deal after lease deal after lease deal with very big players, and we love to see it. Not only are they adding lease deals, but you're also seeing capacity expansions, headline growth in AI infrastructure bookings, and the company becoming better and better managed in terms of overall losses. Obviously, in the AI data center space, if all of your competitors are willing to spend above and beyond their revenue, well, if you decide, oh, you know what, actually my main goal is printing profit, well, that means that you're going to be out of business in 2 to 3 years because, well, your AI data centers are going to be obsolete. So when people say, oh, don't buy data centers because a lot of them have big losses, well, let's be real. If they don't, they're going to be out of business because you can't be competitive without investing tons and tons of money up front. Now, in terms of key upcoming catalysts, I see large new lease or hosting deals as a potential thing that could validate their facilities and capacity even more and cause more rallitos. I see capacity ramp up announcements. We've already seen a lot of that. You have new data centers, anything in terms of new data center campuses coming online, new gigawatt pipelines being announced, anything in terms of demonstrating cost efficiency or differentiation in cooling/power, any new strategic partnerships, those also have a big impact on the price. Now, what about the chart setup overall? Well, quote, APLD data center play is finally taking a much needed breathing cycle. How far will she drop? Well, in case A, we see a continued slump to $20 and then a rebound back through previous resistance levels and slowly up to previous cycle highs. In case B, we see an even further dump to $12 previous channel highs and a resurgence. In case C, we see a more immediate bounce back coming in the next few trading sessions. As a long-term play, we are happy with all potential cases given, but understand that bigger dips can be even better opportunities for better deals. Number 4, Energy Fuels Inc., ticker symbol UUUU. For use. So what exactly is Energy Fuels, Charlito? Well, Energy Fuels is a US-based mining and processing company focused on uranium, rare earth elements, vanadium, and other heavy mineral sands. In simple terms, they mine and process raw materials that are critical for nuclear energy, clean tech, and advanced manufacturing and are very relevant in the overall scale up right now for the AI data center race. Now, they aim to supply the building blocks for things like carbon-free nuclear power and rare earth-dependent technology. Right now, we're in a very big energy pricing crisis, and energy prices are going to go up and up and up as data centers use more and more power. And nuclear is a very key component, and this play does fall largely into the uranium nuclear energy category. And with pricing trends, it makes sense to use more and more nuclear energy. And so investment, I believe, is going to head into this direction. And I think that triple U, or rather quadruple U, is a big play for that. Now, we actually just alerted calls on the stock in the Discord a few minutes ago, and if you would like to see those calls, well, just go ahead and join us with that first link down below. If you're already a member, you just have to go to the Options Idea tab. Okay, number 3, QBTS, which is D-Wave Quantum. D-Wave Quantum builds quantum computing hardware, software, and cloud services. Their kit includes quantum annealers, their specialty developer tools, cloud access, and services to help enterprises apply quantum to real problems. Their mission is essentially to make quantum computing not just cool science, but practical for optimization, logistics, drug discovery, finance, and manufacturing. So what makes this stock stand out in the quantum space? Obviously, we've been fans of this stock since way lower valuations, all the way down in the $2 region a couple of years back. Now it's trading 10x plus higher. Why have we liked it, and why is there continued upside? And why is this something that you'd be fine if you bought the dip during bear markets and you accumulated over time? Why? Well, the one thing about D-Wave is their edge is commercial adoption today. They have a stack, hardware plus software plus cloud plus services. They have real customers today in manufacturing, logistics, finance, solving real-world optimization problems today, which gives them a first mover in the practical use case of quantum area. We've been talking about this for a while, but quantum is actually the next leap in terms of AI compute. We're still very, very early innings now, and the technology is really, really out there. But the reason that so much investment is going into this category is because everybody wants to have the next gen computational power. And QBTS is one of the first movers here. Now, what about the current chart setup? Well, we've been yelling about QBTS since the $2 range years ago, but here's what we sent out to Discord members today. Quote, where will QBTS bottom for the next cyclical bounce? We love this long term, but the volatility will always be here. Critical levels of support are at $26, $24, and at $18. On watch for next few week breakdown and recovery cycle. Okay, number 2, USAR. So USA Rare Earth is a US-based mining and manufacturing company focused on rare earth elements. Their aim is a mine-to-magnet strategy, extract rare earths domestically, process them, then manufacture the high-value magnets used in everything from EV motors and wind turbines to defense systems and electronics, and specifically AI data centers. Given how many industries are chasing supply chain security and clean energy transition, USA Rare Earth is positioned as a domestic supplier in this critical segment. So why does USAR stand out in all the different critical mineral plays? Obviously, we like a lot of them, but why does this one stand out right now? Well, what makes their story stand out is they're not just mining raw ore, they're actually trying to capture value further down the chain by processing and manufacturing magnets. That vertical integration can be a big differentiator. The market segments they serve, electric vehicles, renewable energy, defense, electronics, are expected to grow pretty substantially, and as countries and companies push to de-risk supply chains and move away from overdependence on foreign sources, especially China, for rare earths and magnets, well, USAR's positioning becomes more and more relevant. Now, what are the tailwinds and the potential catalysts for the stock? Well, I've identified a few for you. The demand for rare earth magnets is rising sharply due to AI data centers, EVs, wind turbines, robotics, drones, and electronics. Policy emphasis is increasing for critical minerals and domestic supply chains, especially in the US, which could generate incentives or preferential treatment. And if USAR can scale mining plus processing plus magnet manufacturing, which they've been doing, the margins could expand as they move away from selling ore towards higher, much higher actually value products. All of this suggests there could be substantial upside in the future for the stock for the patient. Okay, and lastly, number 1, SoFi. SoFi, as they say in Charlie Land. Now, SoFi in many ways has been a OG play. We've been talking about this for years. It has performed, it's gone up some multiples, but it's nowhere near where I thought it would be. And I think there's a big arbitrage opportunity here. I think the stock is actually underhyped. I know it's at all-time highs, but I actually think it's really, really underhyped. SoFi is a fintech company that aims to be a one-stop financial app for consumers, offering things like student loan refinancing, personal loans, mortgages, checking, savings accounts, investment accounts, credit cards, and more. And the way that I've always looked at it is they have this user base. The user base is growing massively. The user base is using more and more of their services. The user base is generating more revenue for SoFi per user. All of these things are great, and you can kind of see the exponential flywheel there. Now, these are the catalysts that I would keep in mind as we head into the upcoming quarters and as SoFi reports their earnings. So accelerated growth in members and products per member. When SoFi shows it can reliably monetize users with multiple products, that signals scale, and that's what they've been doing for years. I think it's going to heat up massively. Expansion of its technology platform business could deliver much higher margin revenue as well. Any move into new geographic markets or new product areas, crypto, remittances, or international services, that could drive the needle. And further improvement in profitability and operational leverage as a net of all these efforts and more. It's going to be obvious that as more and more users and products scale, well, fixed costs are going to get absorbed better, and you're going to see the overall profitability and the marginal profitability really start increasing. And once that happens, I think you're going to see the stock re-rate much higher. By the way, if you'd like to see our SoFi calls, make sure to check those out in the options idea tab in the Discord. Anyways, folks, that caps off today's video. Have a great rest of your day, and we will see you in the next one.